My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make a little money. My job is not just to entertain, but to educate, teach. So call me at 1-800-743-CBC. Tweet me at Jim Cramer. Can't beat the numbers we got this morning. Last night I told you we had to root for weaker hiring and muted wage growth because that's what gives the Fed a reason to cut interest rates. And that's exactly what we got. No wonder the Dow gained 450 points, S&P shot up 1.26%, and the NASDAQ vaulted 1.99%. Now that we've finished with the Fed meeting and the labor report, I'm hoping we can focus back on individual stocks, at least just a little bit, not just the interplay between the bond market and the S&P 500. Remember, now that we have a clear signs of a slowing economy, we got to look at stocks with a bullish slant, because in this environment, we won't be fighting the Fed. Something we were very worried about in April. The numbers now tell us that those fears were unjustified. Just like Apple pulled back hard going into its good quarter, it reminds you that the critics and commentators can often lead you astray.
The House of Pain.
So with that in mind, what's with the game plan? All right, it all starts not Monday, but Saturday, when we hear from Warren Buffett, the Oracle of Omaha, who will no doubt be incredibly positive about pretty much everything, especially his portfolio. That could be bullish for Berkshire Hathaway, as well as American Express, Coca-Cola, Apple, and most of all, Occidental Petroleum, which is the stars of his portfolio. Hey, by the way, the whole thing's going to be covered by CNBC. I mean, I don't know what you're doing tomorrow. I know what I'm doing. Now, Occidental's especially trenchant as the oil giant reports on Tuesday after the close. Buffett loves it. I think Buffett will mention Apple several times. He's got a new phone coming. Maybe he's wise to that. He's going to hold on to the stock, I believe, even though it's a gigantic position. He'll also probably talk about how Berkshire's gigantic cash hoard can't be used. He can't find anything to buy. Still, the rosy U has worked far more than not. Monday morning should be a good day. Bears beware. On Monday morning, we also hear from one of my favorites, Tyson Foods. I still think this is a bounce-back play. It's too cheap and despised on Wall Street for missing many quarters, but that was many moons ago. I like the setup of Tyson Foods. I have now. We've called the bottom, and we've been right. After the close, one of my absolute favorites, Simon Property Group, is going to report, and this may put up some just terrific set of numbers. With that 5.5% yield, the risk seems low, while the reward may simply be just, I think, sensational. Remember, this is the highest quality mall REIT in the world. Simon Properties was on last time. I thought they told a fantastic story, frankly. Tuesday morning, we hear from Disney. Interestingly, by the way, just report in the evening. Perhaps that's the influence of CFO extraordinaire Hugh Johnson, formerly of PepsiCo, who leads what I think what's going to be a real orderly conference call for once. I think we should get some excellent numbers because of all the initiatives and cost cuts Disney put in part to fend off Nelson Peltz in that rough and tumble proxy fight. Aren't we glad that's over? Next. We're constantly on the lookout for anything good coming from China, right? And we get results from Wynn Resorts on Tuesday night. Wynn owns 2 casinos in Macau, the Chinese gambling haven. I think it put up some good numbers, which is why we own it for the Travel Trust. The Chinese seem to be willing to travel locally, even as they eschew visiting here. Also, at the close, this is a new one, Reddit reports. And I'm thinking they're going to put up some healthy numbers right out of the chute. Pinterest and Snap recently reported excellent traffic and advertising. Those are good comparisons for Reddit. I anxiously await a very positive story, in my humble opinion. Now, we go to Wednesday, all right? Wednesday, we hear from Uber in the morning. Now, I wonder whether they might be seeing some impact of a newly revived Lyft, that David Rich is doing a good job, you know that, and possible sign that Uber's become too expensive to use. I worry about these things. I keep thinking that the negative report from DoorDash this week might be a little similar to Uber, and we could see as a suboptimal traffic number. When it comes to cars, we're also fascinated with Elon Musk, right, and Tesla, that maybe we ought to sober up and listen to Toyota Motor when it reports. It's becoming increasingly clear that the sweet spot for automakers is not EVs. No, the EVs is not, it doesn't really matter here. It's hybrid vehicles, where Toyota's long been a leader. I think they'll put up great numbers like we used to expect from Tesla. But remember, it will be hybrid. After the close, I really like ARM Holdings, and I think we could see some very strong numbers from Renee Haas and Company. That's the advanced semiconductor design firm that it kind of reminds me of Qualcomm. What a home run that's been. I'm also expecting a terrific quarter from Airbnb, but that's after listening to Expedia's conference call last night, where they talked about Airbnb's competitor Vrbo, VRBO, having some technical issues that really hurt business. Hey, look, what's bad for Vrbo is most likely good for Airbnb. I mean, hey. Robinhood had a real good quarter last time, and I bet we could get another one. That's given how popular crypto remains, as we learned last night from Block, the artist formerly known as Square. Hey, by the way, Block is doing very well. The Trade Desk might deliver a good quarter, as there's been so much advertising money spent on streaming, and these guys offer an alternative to Google for digital ads. I really like Jeff Green's model. Oh, and we don't want to miss the tremendous production that will be the once loved, now scorned AMC Entertainment. I still can't believe this $3 stock traded at $380 just 3 years ago. I saw GameStop going up at the end of the day today, and I just said, well, there's no accounting for taste. Now, it's been my experience that when you get a surprisingly good quarter from a good company, then there's probably more often than not another good quarter. And that's why I'd be looking into Roblox, buy some ahead of time. It's delivered an excellent quarter last time, and it should repeat it when it reports Thursday morning. Sometimes stocks just become lightning rods, and one of those reports on Thursday, and that is Warner Brothers Discovery. Yeah, I know, under 10, you can't resist, right? Two issues here. Will they keep the NBA contract? That makes them so relevant. And will they have lowered their debt? They need to go 2 for 2 if this stock's going to make it back to double digits. Next up will be Tapestry, the old coach. It's got to address the FTC suit to try to stop its merger with Capri. I think the FTC actually may be onto something to try to block this deal. For once, they're genuinely trying to keep prices down for the consumer, even if it is for something that I would not describe as a necessity. It's more of a accessory. I thought of that myself on the fly. Now, Tapestry might be able to prove that there's a huge amount of choice in the category, and I think they can make a strong case to get the deal done. It needs the Capri deal to make it as much money as possible for shareholders. Not that the current FTC cares that much about that point. And then, after the close, Akamai Technologies. Get this. Akamai reports. Now, this is one of the three content delivery technology companies, and the other two, Fastly and Cloudflare, both disappointed horribly this week. Wall Street thinks that there could be a slowdown in this department. But what if there's no slowdown? What if it's just Akamai taking share from Fastly and taking share from Cloudflare? That's what we got to find out. And there'll probably be the equivalent of pari-mutuel wagering on this one. Finally, on Friday, old Cramer favorite Enbridge reports there's some skepticism about the ability of this Canadian pipeline company to pay its dividend, which gives it a 7.3% yield. I think the dividend is safe, but we do need to see more growth. That's what I want out of a stock. Now, if I have a hope for next week, it's that we don't get sidetracked by different Fed officials who just feel the cacophony. They can't resist, right? They can't resist talking, and the cacophony and the confusion they give us by talking about the Fed's next move is just horrendous for pretty much everyone and everything. You know what? It's amazing to me that they're even allowed to talk about the economy in public. Have you ever seen Supreme Court justices talk about ongoing cases in public? That would be a huge scandal, wouldn't it be? It should be the same for the Fed. But the bottom line, now that it's clear the economy is having a meaningful slowdown, we no longer need to worry about the Fed becoming our enemy again, which means we can go back to glorious stock-picking mode, at least for like a couple of days, thanks to the benign employment number. Big improvement. I say we take calls. I say we go to Brad in Texas. Brad.
Hey, Cramer. How are you doing?
Brad, I'm doing well. How about you?
Doing great. Last time I called was about NRG. That was at $29. I think I'm up over 100% now, so thank you for that.
I like that. Congratulations.
Thank you. And I also loved your interview with that CEO of that one coffee company. I can't remember who they were, but it doesn't really matter. But here we go. San Antonio has the most locations in the country. I physically went to all 28 locations and talked with the workers. The lines don't stop from open to close. The experience is a 10 out of 10. Customer service, 10 out of 10. Price points, 10 out of the 10. Blue-collar workers are here every day. And with 177 million total shares and a 69 million share free float with a 10% short interest and earnings coming up, how do we feel about Dutch Bros?
All right, Dutch Bros reports this week. Now, let me just give you my one problem with Dutch Bros, is that every time it lifts its head, somebody comes in, does some insider selling, and it just wrecks it. But I share your appreciation for Dutch Bros. But remember, the coffee market, I say it's gotten a little crowded? With the Fed meeting and the labor report finally behind us, we're back to stock picking mode for a couple hours. Talk about a big improvement. Oh, man, buddy, tonight, last night you called in about Cracker Barrel. I hadn't looked at the stock closely lately, so I did my homework, and I'm giving you my take. Then the travel boom has been a dependable theme for the last couple of years, and now that a few companies in the space have reported, I'm seeing if the thesis still holds up. And Generac fell 6% after turning in a top and bottom line beat earlier this week, but rallied since. So should investors view this action as a buying opportunity or a chance to get out? Why don't we do this? Let's talk to the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Cracker Barrel, Old Country Stores. I watched it drop steadily from 3 years ago, about 170 to the 50s now. Now it sports a 9% dividend. They got good food, seem to have good management, and they have real estate on their balance.
I know. Let me do this. I myself have been amazed that the stock has dropped like a rock, and I've been amazed because I think they can cover that dividend. We're going to do some work on that because I used to recommend the stock, and it has been horrendous, and I haven't looked at it in many a year, so we'll come back and do that one. Kevin from Missouri, ask and you shall receive. Thank you for that great question last night. And in fact, I have done some homework about Cracker Barrel Old Country Store, the restaurant chain with a retail kicker known for its kind of off-highway locations. And here it goes. Like I said in the old days, Cracker Barrel was really one great stock. I mean, for nearly 4 decades after it came public in 81, it steadily marched higher. I used to constantly talk about it, used to go all the time. But then, coming to the financial crisis, it did become a mega horse, galloping from 10 and change in late 2008 to an all-time high of 185 in late 2018. It's 10 years. When the pandemic hit, though, the stock, it just got eviscerated. But by April of 2021, it was back to pre-COVID levels. This thing was like Teflon. Since then, though, Cracker Barrel's been rolling downhill. It's now $56 and change, only a few bucks above where it bottomed during lockdown in 2020. So what the heck happened here? When you dig into the numbers, it's clear Cracker Barrel came out of the pandemic as a much weaker operator. That's highly unusual. Sure, they've had some revenue growth versus 2019, but much of that's because they acquired Maple Street Biscuit Company in 2019, and that brand became the only real source of new store growth here. More important, Cracker Barrel's earnings are still nowhere near where they were in 2019 because their profitability never really recovered. See, these guys earned more than $9 per share in 2019, but this year they're only expected to make $4.59 per share, and that's down substantially from 2023, too. The cash flow trajectory is similarly subpar. So what's the problem here? First, consumers have been moving more towards quick service or limited service food places rather than full service restaurants like Cracker Barrel. Second, their clientele skews older. And because many older people are on a fixed income, they tend to be more resistant to price hikes. While every other restaurant raised prices aggressively over the past few years, Cracker Barrel hasn't had much room to maneuver, even though they're dealing with the same cost inflation as everybody else. Third, the company's been slow to adapt to the modern era. They only introduced a loyalty program late last year. They haven't had much success appealing to younger people. And while Maple Street Biscuit can give them some growth, it's still too small to really move the needle at this point. They're kind of locked in here. Fourth, Cracker Barrel has some quirky company-specific issues. The whole restaurant industry wants to speed up the paying process in order to get people in and out faster. That's called throughput. But Cracker Barrel has those attached retail stores, the ones with like the rocking chairs. So getting you out the door faster means you're less likely to buy the stuff for the retail side where the big money is. And that's why this stock's been such a nightmare. But what do we do? What do we do with it now? Okay, first thing you need to know, the company is understanding of the problem. See, last year they just brought in a CEO. They poached her from Taco Bell, Julie Masino. And I got to tell you, she's only taken over in November. She's only been on the job for 5 months, but we're already seeing signs of improvement in the latest quarter. Cracker Barrel saw an improvement in traffic trends and better than expected same-store sales, thanks to higher spending and labor and marketing. Seems worth it. but management guided for a meaningful decline in operating income for the quarter that just ended as they continue to spend more money in order to turn things around. See, Wall Street didn't like that. Not one bit. Okay, bad forecast. They want Cracker Barrel to focus on profitability first, hence the recent weakness in the stock. But this spending is actually part of the initial turnaround plan that Messina rolled out late last year. They're spending more on labor and advertising in order to boost traffic. That said, Messina's adamant that there's still a lot of work left to do. She wants to reposition the brand, refresh the stores, bolster Cracker Barrel's marketing efforts. On top of that, she's rolling out new menu items as well as value-oriented menu available on weeknights from 4 to 6 p.m. That's aimed at the early bird special senior citizen crowd. That way they can raise prices after that early dinner wave without losing too many people. Finally, she's planning to find ways to reduce the amount of labor needed to run the stores, which would do a great deal to contain costs and get the margins expanding again. Now, on May 16th, Cracker Barrel hosts and I'm going to quote it, strategic transformation update call, where we'll hear more details on its turnaround plan. Frankly, I want to hear that plan. I got to wait. I can't talk about what I think I would do with this thing until I can't give it a full-throated endorsement until I listen to the call. I say wait because there's one big caveat here. When Kevin in Missouri called in about Cracker Barrel, he pointed out that the yield's now 9%, right? Now, that's a great return, assuming the company can pay the dividend. I said the payout's well covered. It only costs them $150 million per year, which is about half of Cracker Barrel's expected free cash flow. So, again, they can cover the dividend, but now you got to ask yourself, new CEO, do they want to pay it? See, with the new CEO in place and some expensive turnaround initiatives ahead of them, which they do have, it wouldn't shock me if Cracker Barrel decides to cut that dividend in order to free up some cash for its investments. I'd expect that to hurt the stock, but keep in mind that it's been selling off for months because people believe a dividend cut might be coming. On the other hand, if management reaffirms its commitment to the dividend, which I think would actually be surprising, well, then this stock could soar to the point where the yield gets a lot more reasonable. Again, one more reason to wait for the strategic transformation update in 2 weeks. I don't know, maybe you could buy some calls on it and risk, cut off your downside. But ultimately, here's where I come down. I want to recommend Cracker Barrel. I really do. But I'm not quite there yet. I can't get comfortable. I'm afraid of the dividend cut. The possibility of one. Yes, the company's finally come to terms with its structural issues. Yes, I'm optimistic about new CEO Julie Messina and her turnaround plan. She sounds real smart. But before I pound the table on Cracker Barrel, I got to hear what the company says in 2 weeks during the strategic transformation update call, especially on that dividend front. So here's the bottom line. Until we get more clarity on that dividend, you got to wait, okay? But there is a good chance that we'll find out what they're doing in 2 weeks and whether they cut the dividend or keep it. Then we'll make up our minds. Thank you to our callers. Kevin, you're no longer in the show me mode. You're in the do mode. Mad Money is back after the break.
Coming up, can summertime wanderlust make your favorite stocks go gangbusters? Cramer checks in on a few key names in travel. Next.
Last night, we heard from both Expedia and Booking Holdings. They painted very different pictures of the travel business. Expedia stock getting crushed for the second quarter in a row, while Booking Holdings, that's the old price line, it rallied nicely. So what the heck's going on with the travel business? For the past couple of years, this has been one of the most reliable themes out there. Every time it seemed to falter, it came right back. But the parts of travel that are working have changed pretty dramatically. That's my takeaway from Expedia, Booking Holdings, and then Marriott also, which reported back on Wednesday morning. The travel business needs a checkup right now, so let's take one. First up, Marriott. That's the largest publicly traded hotel chain, with a stock that's been very strong for a very long time. Even as it spent most of April pulling back from its highs, it always has intrigued me. I think Marriott delivered a solid quarter. Slightly better than expected revenue, up 6% year over year. Slightly worse than expected earnings per share. Their full-year forecast was strong, but their guidance for the current quarter came in surprisingly light. Beyond the headline numbers, though, there were some discouraging trends, I have to admit. Take RevPAR. This is a key metric. RevPAR. That's revenue per available room. Marriott's RevPAR grew up by 4.2% year over year. That's 40 basis points lower than what the analysts were looking for. Occupancy rate was a little light. Pricing a little light. Not ideal. When I listened to the conference call, management talked about diverging trends between domestic leisure and leisure travel and basically the rest of Marriott's business. See, the company said that travel demand has normalized, that's a bad word in this case, in the U.S. and Canada, meaning the post-pandemic boom is now over. But they also noted that the rest of the world's doing great. Marriott's international revenue per available room was up 11%, led by 16.5% growth in Asia Pacific. So the U.S. and Canada slowed, but international's on fire. On this news, Marriott's stock fell a couple of bucks in response, but then it had a nice bounce yesterday. I think it's fine to own this one. What I'm focused on is the internal shift from domestic to international, which brings me to the two online travel agencies that both reported last night. The short version is Expedia bad, Booking good, as reflected by the 15% decline in Expedia today versus a 3% gain in Booking. That's a fair assessment, but there's some important context that you get when you really drill down into these two quarters. In terms of Expedia, the actual quarter was just merely mixed, not a terrible disappointment. It was, though, a little unnerving, which is what you expect from the hideous decline in the stock. See, the bookings came in a little light, but the revenue was better than expected, up 8% year over year, earned 21 cents per share. Wall Street was looking for a 14-cent loss. Even the weaker bookings weren't really demand-related, but this is what mattered. Expedia's Vrbo home rental platform, their Airbnb knockoff, had some technical issues that took the platform offline for a sustained period of time. That, people, is devastating. The company's trying to migrate everything onto the same platform, but something clearly went wrong in the process, and it just crushed the quarter. However, Expedia had pretty good things to say about the rest of its business, including, in their words, quote, some acceleration in the rest of our business-to-consumer business, end quote, which the company expects to continue throughout the year. But given the hit from the Vrbo tech problems, Expedia had to cut its full-year forecast. Rather than the previously expected double-digit bookings growth with margin improvement, Expedia is now looking at a mid to high single-digit bookings growth with flat margins. And that's why the stock got absolutely pulverized today. So then you got to ask yourself, did the sellers overreact? Honestly, I am tempted to say yes, as this appears to be a one-off issue, even if it's dragged on for longer than expected. Expedia is now a very cheap stock. It's trading at less than 10 times this year's earnings estimates. Plenty of growth expected over the next 3 years. But I still have one major hang-up here, which is that these Vrbo issues mask the core consumer travel demands. So it's hard to get a read on the state of the industry from Expedia. Here's the swing factor for me. Expedia's CEO is on his way out. In February, the company announced that Peter Kern, a friend of the show and very smart guy, we've had him on the show, will be passing the reins to Arian Gorin, okay? Previously the head of Expedia for Business, effective 10 days from now. Well, that isn't that smooth a transition, or at least not one that I hope for. So I have to put Expedia in the penalty box for at least a quarter. Finally, let's talk about Booking Holdings. The star of the night of the whole stock market. Well, no, I guess you can include Apple, right? With an excellent set of results. The bookings grew by 10% year over year, coming in much better than expected. Room nights booked up 9% total revenues up, 17%, earnings up stunning 76%, all better than expected. Wall Street was only looking for $13.98. They gave you $20.39, not even the same zip code of the consensus estimate. And that's why the stock just took off, rallying 3% today. Bookings gave us some lowball guidance for the current quarter. I think it would have been up as much as Apple was. I'm not too concerned about that, though, as these guys like to underpromise and overdeliver, and that's what they always do. What's the key difference between Booking Holdings and Expedia? Aside from the unforced error with Vrbo, Expedia is mostly a domestic travel play. 63.5% of its sales from the United States, according to FactSet. Booking Holdings is mostly international. It only gets 11% of its sales from the United States, really huge in Europe. And remember what Marriott said, while domestic travel is normalized, post-pandemic international travel is still booming. For Booking Holdings, Asia room nights grew mid-teens. Europe and the rest of the world were up high single digits. Meanwhile, America was up low single digits. President and CEO Glenn Fogel, you might have seen him on Squawk Box today. He had this to say.
When we came out of the pandemic, there was that revenge travel, which has petered out a little bit. We're getting more a normalized travel environment, though Asia is still recovering somewhat, which is why we had such nice numbers last night to announce about Asia with a mid-teens growth over last year. That was more a post-pandemic benefit. Look, all around people want to travel, and we're glad to be able to provide great services to them.
I think I sold my book back there. I'm not kidding. One of my books is there. All right, putting it all together for Marriott, Expedia, and Booking Holdings, here's how I'd sum things up. Demand for travel remains solid, but leisure travel does seem to be waning a bit here in the U.S. These companies are framing that as a normalization after some boom years, and I think it's a fair description. But the global travel industry still has plenty of sources of growth, like group and business travel, where the recovery started later and has unfolded more slowly. Same goes for international travel. So here's the bottom line in this incredible theme that I don't want to lose. I think it still has legs. It's just that they're different legs from 6 months ago. The more internationally oriented plays like American Express or Booking Holdings can keep working, but the more domestic-focused airlines and hotel chains, I think they're in a worse spot. And that's where we are right now. I want to take calls. I'd like to go to Drew in Idaho. Drew.
Gem State Booyah from a charter member of the investment club.
Yes, man, I am thrilled that you're in. We're going to try to keep delivering for you.
Gonna ask you about this stock that I started following it during COVID in the hundreds, closed today at 15. Is the synergy with ESPN an opportunity or a trap? I'm talking about Penn Entertainment, PENN.
Look, if you're going to go down that area, you want to go Wynn for big casino, and you want to go DraftKings for gambling. Those are the two kings, and those are the ones I'm offering. I'd like to go to Peter in New Hampshire, please. Peter.
Jim, how you doing? TGIF. Thank goodness it's Friday.
Yep, I got nothing going at all this weekend. I'm pathetic. What do you got cooking?
A little bit of extra work and hopefully getting some kids outdoors.
Okay. Remember, you want to go for the 12 horse. There's only 11. I'm not doing anything wrong. Go ahead.
Hey, I'm looking at Stellantis, STLA. I got in for a couple dividends, but however, it's retracted about 25% since it's.
The quarter wasn't that good. I was actually surprised. These guys have been as consistent as can be. I'm going to have to recommend that you do Ford. Why? Because Ford would be nuts not to do a buyback right here. They should be just buying stock hand over fist. Stellantis isn't bad, but I was surprised they did not deliver on the quarter. All right, look. The travel theme has still got legs, but you need to consider international-oriented places like American Special Booking Holdings compared to their more domestic counterparts. Much more Mad Money ahead, including my exclusive with Generac. Does this energy tech company have what it takes to power your portfolio higher? I'm getting the latest from the CEO. That Apple is a bright spot in today's tape, but there was one aspect of the company that is not being mentioned at all as part of the upside, and I think it's got tremendous potential. I'll reveal what it is, and of course, I'm going to take your calls rapid fire transition of the lightning round. So stay with Cramer. What's going on with Generac Holdings? It's the number one maker of home backup power generators that also has a big business making batteries for renewable energy. On Wednesday, Generac reported a nice top and bottom line beat, but the stock still fell more than 6%. Why? Well, management said the residential business is likely to do worse this year, even as they think it'll be offset by better than feared numbers in the commercial and industrial side of the business. But after a big bounce today, the stock has now made up most of the ground that was lost on Wednesday. So was the market's just reaction a mistake, or is this post-earnings rebound your chance to ring the register? Let's check in with Aaron Jagfeld. He is the chairman, president, and CEO of Generac Holdings. Get a better read of the situation. Mr. Jagfeld, welcome back to Mad Money.
Hey, Jim, how are you doing?
All right, well, Aaron, I've been thinking a lot about you and your position. And the one thing that we know, because of global warming, because of climate change, is that everything has not only become unpredictable, but it's unpredictable to the extreme. Which makes me want to know, how can you possibly make a forecast when you are in the most high-risk forecasting job in the world?
It's a tough business to forecast. It always has been. There are things that happen that are outside of our control, but we've always got to be prepared for when they do happen. I think that the one thing we can say about the forecast, Jim, is that we know power outages are going to happen, because they've been happening over the last couple of decades at a higher rate. We just don't know when they're going to happen, and we don't know where. Other than that, we're in pretty good shape.
Well, I mean, you do talk about the idea that we're seeing events that used to happen, let's say, once every 100 years. They're now happening every 5 years. I mean, I don't know how that's possible other than because of extreme climate change.
Absolutely. Look, the science is clear here. Air temperatures are warming. Water temperatures are warming. This is leading to a greater range of severe weather. And that's everything from the hurricanes to the ice storms we see. But also you're talking about heat waves and droughts. You're talking about flooding. All of these things are having a major impact on the infrastructure in the country, including the power grid.
Now, at the same time, we're seeing something that I know you're really acutely aware of. It seems like that everything can't have even a minute down of power. We've got so many different things that cannot possibly go off and they will really go wrong. This is very different from 10 years ago, isn't it?
Now, think of everything in your home. Think of everything in a business. A loss of power today it's much more than just an inconvenience, right? You're talking about a loss of productivity in your ability to work. Look at how many more people are working from home today, even in some kind of hybrid type of work schedule. You can't even do that if the power's out. We're going to electrify everything. We're going to electrify transportation. You're not even going to be able to take your car out if it's not charged. We're putting in heat pumps. We're putting in electric ranges and stoves, and we're trying to get rid of all, the gas appliances. The more we electrify things, the more this is going to become a problem. People are going to have some kind of a backup strategy.
Well, will I be in a situation, because I have stuff that I can't have go down, where I have to start thinking about my power company and perhaps thinking that, you know what, my power company has had a lot of irregularities, so I can't afford to be there without a Generac?
Absolutely. I mean, this is the decision that all of our customers have been taking. They say, look, I have, and whatever it is in your life, right? Everybody has something that's so important to them from a power standpoint that they can't risk interruption. And so they can't depend on a single source for power anymore. You have to have a backup. That backup could be a generator. That backup could be a battery. It all depends on your needs and your situation.
Now, when I look at some of the people, like we have this great guy, Shug, we call him, from Nextracker. He's saying that 50% of our power is going to come from renewables, 25% solar, 25% wind, and I think about 100% nightmare. Because sometimes it's not sunny and sometimes it's not windy. So I don't know what else to do other than have a Generac.
Well, this is the real problem. I mean, look, the grid is changing. And so I think that renewables are coming in, right? Utility scale wind, utility scale solar. It's coming in at basically on par from a cost perspective with some of the traditional thermal assets we've used, like coal and gas. That's the good news. The bad news, of course, is exactly as you pointed out, those new renewables are intermittent, right? And by the very nature of that word, they don't operate 24/7. So how do you cover that gap? So it's becoming incredibly complex for utilities and grid operators to balance supply and demand, because demand spikes occur when, in the middle of the day and on a weekend, and they've got to be ready for that. Today, they use what they refer to as reserve margin, right?
Right.
It's the amount of production over the peak demand. Those reserve margins have slowly been shrinking. And this is before we even get to the explosion that is AI.
Yeah, I think we're really just, we're all going to have at least mini Generacs now. But how about this notion that people are losing, let's say losing interest in pure EVs, and what does that mean for Generac?
Well, today, I think that EVs, the penetration rate is going to slow a bit. We've got an EV charging product we have in the marketplace. It's not a huge part of our business today. We view it as an important part of the energy ecosystem in your home, as more people, again, they electrify everything in the home, including their transportation. So I think that we're going to go through a period here where it slows down, but then it's going to speed back up. And I think in the end, look, the internal combustion engine driven vehicles and internal combustion cars and trucks are converting to EV. And so you're going to need EV charging long term.
No. So, Aaron, what do I do in a situation where I've been sending power to the utility, and now the utility says, I don't need any more power? Where do I put that power that I was sending the utility?
You put it in a battery, because that's the only place you can put it and still have your system make sense from an ROI perspective, right? So you're exactly right. Utilities are saying, look, I don't want the power, or at least I'm not going to pay you as much for that power as I would have paid you even a year ago or 2 years ago, right? This is going on in California. It's going on in other states where they're actually changing that reimbursement rate for that power, because everybody's producing their own power during the day. They can't buy it back from you at retail rates and turn it around, and they've got nobody to sell it to. But if you put it into a battery, Jim, you put it into a battery and you save that for later, you can discharge that battery as the sun starts to set, right? And your solar production curtails, you bring the battery online, and now you're self-sufficient. And you're using your own power that you generated during the day instead of buying high-cost power from the utility.
All right, that's good. And I need one last thing. I need to know what AI is doing in the process of electricity.
So AI is an incredibly energy-intensive technology. It's great stuff, and we're just on the tip of the iceberg here. But a single chat GPT request takes 17 times more power, more energy-intensive than a Google search. So think of that for a second, right? One chat GPT discussion, 17 times more. The amount of power that AI is going to consume through data centers that are coming online here over the next 5 years, it's going to be the equivalent of adding 40 million households to the U.S. grid. And we're just not prepared for it.
But that's insane. I mean, I must have done 100 searches today. Are you telling me that I personally, my footprint was gigantic today?
Massive. Massive, Jim.
Now I'm bummed. Well, anyway, look, you are just a breath of fresh air yourself. I do love my Generac, by the way, because I love my Generac as much as I hate my power company. How about that? Because they are not mutually exclusive. They are inclusive. I want to thank Aaron Jagdfeld, Generac Chairman, President, CEO. It's always great to have you, Aaron. Thank you so much for coming on.
Thanks for having me on, Jim. Appreciate it.
Man, buddies, back after the break.
When we return, master the markets one stock at a time. The lightning round is up next.
It is time. It's time to light round. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round claims. I'm going to start with Glenn in Florida. Glenn.
Good evening, Mr. Cramer. Thank you for taking my call. I must say, I truly love your show. I appreciate everything you do. My stock that I'm looking at is HCA Healthcare, ticker symbol HCA, sir.
Last quarter, good. I'm going to have to go with it. I know it's been uneven in the last year, but it's been a great long-term horse. Let's go to Sharon in Minnesota. Sharon!
Booyah, Jim.
Booyah, Sharon.
I just want to say, hey, I'm a club member. I really appreciate it. And
Thank
the
you.
other thing I want to tell you is that thank you so much for encouraging people to rescue pets and not shopping for them.
Oh, we're not doing. My daughter's doing cats now. I'm doing dogs, and she's doing cats.
That's great. So my question is about GE Villanova, whether it really it's really shutting up, or Oracle, which used to be.
Okay. Well, first, this is an interesting thought because right now it's really a play on natural gas distribution. I know it's got, people want to be about wind and it's got nuclear, but it's natural gas. And believe it or not, natural gas is very strong. So I think the stock is a buy, but it may not be the environmental play that people think it is. How about that? Let's go to Bo in South Carolina. Bo!
Hey, Jim. It's awesome to talk to you. I would like your opinion on Live Nation right here.
Okay, if it weren't for the fact that I fear government investigation, I would say buy, because they really own this market. But I think that's the problem. I think the government doesn't want them to own the market. Let's go to Mark in Wisconsin. Mark!
Dr. Cramer.
This is chill.
I got a stock for you, but I'd be more interested if you had any insight or guidance as to who might win tomorrow's Kentucky Derby.
It will not be mainstay, and it will not be. No, I tell you, I'm not really allowed to offer that kind of advice. I am going to be making my bet, and you can check on Twitter, but I'm not going to do it here on the show. I'm sorry.
Okay, Al, I got a stock for you. It's in the IT sector. It's not making money right now. So win, place, or show on ticker KD, Kindrell.
Okay, Kindrell's the last 2 quarters have been terrific. Martin Schroeder's done a remarkable job. It's been going higher and higher and higher, and I think that Martin's going to continue to deliver, and it's a good opportunity. Let's go. I feel better about that than offering my picks, like the number 11. What do I know? Let's go to Joe in New York. Joe.
Jimmy Chill, booyah, brother.
Chill man in town. What's happening?
I'm looking at Rubrik.
All right, now understand this. So if you're willing to own a very expensive enterprise software company, you can own Rubrik because it is a really good company, but it is really expensive. Now let's go to Deborah in Connecticut. Deborah.
Hi, Jimmy. Thank you for taking my call.
No problem.
Very long time, first time.
Excellent.
I'd like to get your thoughts tonight on Dorian LPG Limited.
I know it seems so cheap, Deborah. My problem is that I've never made any money with these shipping stories, so I can't. It's almost like I'm a jinx. I know that this one looks like it's going higher, but I got to stay away because I just can't value them correctly. Let's go to Connie in California. Connie.
Hi there.
Hey, Connie.
Jim, I'm wondering if now is a good time to buy APA.
Now, Anadarko got bought, and that left only APA as being like the one that I thought was left to be bought, but it's not gotten bought because it got too much natural gas. So I'm going to send you to Coterra. That's my fave. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, the buyback heard round the world and a vision for the future. Cramer caps the week off with Apple after the break.
Apple stock is a complex beast. There's so many variables that go into its trajectory. Today, the stock rallied 6% thanks to last night's quarter, and most of the media attributed the positive response to Apple's new $110 billion buyback, largest ever. Look, I can't dismiss the buyback as a reason the stock might have gone up, but CFO Luca Maestri explained that the scale of the buyback is less about propping up the stock, more about Apple's continual attempt to be cash neutral. It had $58 billion in net cash at the end of the quarter. Given that the company currently has $105 billion in total debt, this repurchase plan is simply in line with what you'd expect, and it's what they've given you. It's not CEO Tim Cook playing the market, judging the stock is overwhelmingly cheap or something. No, I think Apple roared today because its Chinese sales defied the gloomsters, all those surveys that told you that things are getting worse. According to Kantar, who keeps track of these things, the two best sellers in urban China were the iPhone 15, the iPhone 15 Max. Wall Street expected the cadence of sales in China to go from bad to worse, but it actually improved, which I felt quite encouraging. That benign China scenario helped Apple offer a forecast of low single-digit growth. That is a heck of a lot better than what you'd expect if you were listening to the skeptics, who insisted Apple had become a no-growth company and were looking for about 1%. With these numbers out of the way, Apple stock now has a pretty clear glide path. First to the all-important developers conference, the WWDC, on June 10th, and then to the new iPhone launch in the fall. The next generation phone might be a must-buy. Why? Because of all the AI that will be loaded into it. Tim Cook assured me that if I love the Android AI, which is very impressive, I'll go crazy for Apple's technology. Funnily enough, the one thing nobody in the press mentioned as an upside surprise was the Vision Pro and spatial computing. Remember, that was this new device that had just come out? I couldn't find a single word in Wall Street research even mentioning this $3,500 gadget anywhere. Nowhere. Now, I did, however, read in the computer media about how it's a total bust. As PC Gamer said today in a vicious headline on a horribly negative story, and I quote, more than half of Fortune 100 companies have bought Vision Pro units, according to Apple. So it's at least sold at least 50 of them. Ha, 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 ha. All right, good punchline. But for the record, I'm hearing something completely and entirely different. I'm hearing that the Vision Pro and spatial computing are both hits with the enterprise, not the consumer, but with the enterprise. And the business-to-business applications are going to be used in all sorts of industries. I can't stress enough how important this is, because when I went out to the NVIDIA GTC event 2 months ago, I saw the Vision Pro hooked up to NVIDIA's supercomputer, and it let me check out a Nissan Roadster without ever leaving the room. Of course, there was no Roadster. It was just a chair. But it worked just as well as a visit to the car dealer, except I wouldn't have had to leave my house. I understand the consumer may not be crazy about the device. It's a $3,500 headset. You can find something for Meta for $500. The Vision Pro is viewed as an expensive toy that might be good for, let's say, flying across the country watching a movie. Nothing else. But I keep telling you that spatial computing belongs in the enterprise. It's only a consumer product for those with a lot of money to burn. If Apple can attach it to an NVIDIA Omniverse, the business applications are endless and really bountiful. You can use it to create digital twins of any structure or product, then plan it out in VR to solve all the potential problems before building in real life. Any company contemplating constructing any sort of building, and by the way, that is the largest total addressable market in the world, would most likely demand that all involved be wearing a Vision Pro so they can build things together, saving time and energy while reducing waste. Hospitals, operations, perfect. Selling cars, amazing. Homes, perfect. I think the jokes about the Vision Pro will be retired next year when the enterprise adopts it and buys hundreds of thousands of them at a high price point, at which point this thing would be an actual needle mover for Apple. You need to be ready. Even as the stock soared today, that possibility is not baked into the share price at all. Vision Pro, laugh now, pay later. I'd like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you Monday. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.